We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Craig Hemke from TF Metals Report. Craig, how are you today?
Tom, I'm doing great. Thank you. Very nice to see you. And thanks for the opportunity to sit down and talk about stuff.
It's always great to chat with you, Craig. And it's been a little while since we've spoken. But, I thought we could kind of start here by getting to revisit your latest macrocast for 2025 here. I think it's funny and interesting and also valuable that you acknowledge that parts will be proven wrong. However, it's always a great exercise to understand what we were thinking, let's say, as this year has began or when the year was beginning and what surprised us as to how the year progressed. You and I were kind of talking a little bit before the show or before we hit record here today. And it really, to me, feels like the entire chessboard has just been thrown up into the air. So what factors do you think proved to be most important last year for gold's drivers looking back?
Yeah, that again, that gets to the heart of, like you said, why I write these things in the first place. It's not like there's not a lot of upside whenever you forecast anything. Mm-hmm. It's because it's like you get something right and it's like, well, yeah, anybody could have seen that coming. And when you get something wrong and it's out there in the wild, that's just an invitation, for trolls and people to just lay it to waste. And so, but I got in the habit, 7 or 8 years ago, of cobbling my thoughts together. Late December, early January, just say, okay, well, here's where I think we're headed. Mm-hmm. And what it turned out to be was kind of an exercise just for me, so that when we get to December and you have this, price went up, price went down, price went sideways, I at least can go back and look and say, well, here's what I got wrong. And here's why, because I remember this is what I was thinking. Because everything comes at you so fast every day, and it's like you can lose track, of the narrative, get the bit falls out of your mouth, whatever metaphor I can come up with. And so I need these macrocasts to go back to refer back to. So you talk about, okay, last year is a good example of that, because I thought that the key in 2024 would be, well, how soon is the U.S. going to be in a recognized recession and that the Powell's going to start cutting rates and all that kind of stuff. And I thought, well, it would probably take at least half the year before we get that going. And then maybe that would kick in and we get to maybe $2,300 by the end of the year. Well, hell, we were $2,300 by March. Mm-hmm. And, and the dollar was going up and rates were going up, and yet gold was going up with it. Well, that was unusual too. So what I missed, and I think what I missed kind of carries over here into this year, is that central bank demand. And this, I think we can trace the record central bank demand for gold, which now is 3 years in a row, north of 1,000 metric tons net. And I think you can retrace that back all the way to about this time 3 years ago, when Russia invaded Ukraine and the US and the EU froze their foreign-held foreign currency reserves and kicked them out of SWIFT. Mm-hmm. And I think that was kind of the key driver that woke up this central bank demand, where, other countries around the world went, whoa, wait a second. We may get along with the US and the EU now, but they'll kick us out of SWIFT too, I suppose, if they ever think we're going against them in anything, and that's inevitable. So the central bank demand left a kind of a physical floor, a physical bid under the gold market, and that kept it from falling backwards and even falling back sharply in an environment where, with the dollar going up and with the rates going up. Mm-hmm. That has carried over to this year, and now it makes you wonder if that hasn't finally started to really impact the readily available supply of metal, the float around the world. And all those things seem to connect. But yeah, that's why I write those macro casts. And I think so far so good on this year's cast. I think it's working out pretty well.
Mm-hmm. Well, it's interesting to consider that situation with Russia and their foreign held reserves that were seized by the US. And I think I read this morning that Europe is looking at doing something like that to them now as well. And like
actually taking the reserves. I mean, not just freezing them, but in the absence of maybe the US continuing aid to Ukraine, using the Russian money that is frozen and using it to give it to Ukraine. Now, again, I'm not going to get into the politics of all that and whether that's a good idea or a bad idea. In the world of global finance between sovereign countries,
in the world of confidence.
Yeah, that's a game changer. So, yeah, that's a headline that needs to be watched.
Mm-hmm. Do you think the Fed is as important in this upcoming year as it once was and as it has proven to be in the past?
Yeah, I'm not ready to walk away from their impact on the markets and monetary policy and liquidity, everything else that the Fed provides. That's one of the big changes we've already seen thus far this year that I wrote about in the Macrocast. The title of it for this year was called Inversion Reversion, which was kind of a play on the yield curve that I think most folks, maybe I shouldn't assume this, but I think a lot of people understand that an inverted yield curve where interest rates on the short end are higher than interest rates on the long end is a precursor of recession. But using the Fed's own charts, the recession begins when the yield curve uninverts, where you flip back to where the long end is higher than the short end. That happened in October of last year. So that, well, this recession now is either right upon us or coming, and we're starting to see that now in the GDP now data for the first quarter. Anyway, the moral of the story is we entered this year after the December FOMC with people saying one rate cut at most now, maybe in 2025. Well, with the way everything's changing, Fed funds futures are now pricing in 3. Mm-hmm. Things really get away from us. It might be 4 or 5. And here's a wild card for you. Maybe by the end of the year, they're even talking about things like yield curve control. So does the Fed, I don't know if, getting back to your question, does the Fed directly impact the markets and the economy? Yeah, because that change of policy trickles down, not only impacting liquidity, but impacting the expectation of liquidity. And that then has, that's a driver that pushes the dollar down, that pushes the metals up, that sort of thing. So yeah, no, I still think the Fed is important in all of this for sure.
Mm-hmm. Craig, when we think about, and we're kind of touching on this idea of the expectation of liquidity, what do you think the chances are that we enter another round of quantitative easing as well? Because that seems to be able to serve the aims in some ways of Trump's lower dollar, but ultimately, for the people that are paying attention, we know that this is also going to create more inflation down the road. So, what do you think the chances are of that?
Yeah, here I'm not meaning to do that. I'm going to refer again now. Maybe have you put a link to that inversion reversion on here someplace so people can go read it, because here I'm referring to it again, and I didn't mean to keep doing this. But this is a problem. I mean, the money's got to come from somewhere. Again, ending last year is like, oh yeah, Trump's going to cut the deficit in half, and all this kind of jazz. Well, we'll see about that. The current political problem is, another big fat omnibus bill, continuing resolution, keeping spending at the same pace that it's always been. Mm-hmm. And we're already on a track 4 months through the fiscal year. We're going to be about 5-6% ahead of last year's spending. So we're on track to $2 trillion more in deficit spending. Well, that money's got to come from somewhere. The last couple of years, we even had this reverse repo balance where there was so much cash created in the response and recovery from COVID that banks parked $2.4 trillion at the Fed in their reverse repo account. Got that high by about the end of 2022. Well, by the end of 2024, and now it's like $90 billion. I mean, that's all been exhausted. And a lot of that money flowed out into the short end of the yield curve as Mother Yellen kept issuing T-bills last year, in new issuance to raise cash. Well, now that's all been tapped out too. So this cash has to come from somewhere. So I think the playbook has been quantitative easing. And that's what it will be again, because the government's not going to stop spending and the money's going to have to come from somewhere. And that's what they've done for 15 years, 16 years now. The paradigm shifted way back then. That's what they'll continue to do. I think eventually, though, what it gets into, Tom, is more of a, rather than we're going to buy these level of treasuries, we're going to buy these mortgage-backed securities and, kick some new cash out into the bank's hands and out in the market. I think it ends up in yield curve control, where the Fed just simply, put it simply, they say, hey, we are a buyer of everything above 4%, or whatever, 3%, whatever. And at that point, it's almost unlimited. We're going to peg this rate at this level because of whatever reason. And we're just going to keep printing it, and buying as many bonds as it takes to make that happen. They've done that before. We've experimented with yield curve control back in the late 40s and the 1950s to try to bring down debt versus GDP after World War II. Could very easily do it again.
Well, Craig, do you think they're going to be that explicit about it?
They may have to eventually. That's kind of that's a big picture thing that it would take probably a pretty long runway before they get there. Like I said, they may be talking about it as soon as the end of this year or next, depending on how poorly the economy is doing. Would they be that explicit? It depends. Japan had a yield curve control policy for over a decade. Now, you can't, whether or not that worked, we'll have to see. That remains to be seen. But to me, this has always been about the math, the certainty of the end game. And we're at $38 trillion in debt now. What's that, an average of at least 3%, because the debt service cost is now $1.1 trillion a year. So as that absolute number goes up to 40 trillion, and if the interest rate goes up to 4%, now we're at 1.6 trillion to service it. And it just gets so out of hand as it goes exponential that it's going to require certain things that are not really spoken of in polite company just yet, Tom. And that's just kind of how the math is the math. And so that's why I kind of see those things as coming in the end.
Well, if we combine that, let's say that debt situation with a little bit of the economic data that we've seen, as well as the state of the markets right now, like going into, let's say, over the last year, most of these mainstream equity markets have all seen all-time highs. The math, as you point out, it just doesn't seem to be in anyone's favor, especially Trump.
Yeah, the stock market is such an odd animal at this point. It's not. When I first got out of college and got my Series 7 license in 1990, it wasn't like this, right? And so, it's so radically different than it used to be. And it's so driven by now the 10 names drives all the indices and whether, you're having a good year or a bad year. And so when you can funnel this large amount of cash just into a handful of names, and that creates the illusion, not really the illusion. Well, I guess it is kind of illusion. Creates illusion that the market is doing well. Well, the market is doing well because you measure by the S&P or the Dow or something, and look at it's up 20% or in a year. But it's still driven by just a handful of names. So it makes that using the market as a symbol for how the economy as a whole is doing. It makes that whole thing kind of fall apart, right? I think you could also make the case that some of the stock market gains is kind of the early stages of, maybe not even early stages of this crack up boom. This Austrian economic idea that in the end you just print and print and print and print and print, and that cash has to go somewhere, and everything that's an investable asset just starts going up.
Mhm.
So I suppose there's some component of that as well. I don't know. We're in this pullback now that's almost, it's hard to pin down exactly what's driving it in terms of the stock market. I mean, is it economic concerns? Is it these tariffs and global trade wars? Is it just simply just a rotation little pullback?
Mhm.
I mean, I've called probably the last 10 of the last one stock market corrections. Every time I think, oh boy, here we go. But this one might be a little bit different, Tom, in that back on Monday the 10th, the S&P 500 closed below its 200-day moving average for the first time since November the 1st of 2023. I mean, that's like a year and a half ago. So how that goes is going to impact the Fed policy as well. They've said, they're not paying attention to the stock market, and it could pull back a little bit. Well, I'll tell you what, if all of a sudden, the S&P is back down at 4,000, that's going to slow the economy, right? Mm-hmm. Everyone's going to be getting their 401k statement and going, whoa, what happened here? So it does connect to the economy. It doesn't help, any reforms or whatever that Trump wants to make, because again, the thing has to keep moving forward. The liquidity has to keep being provided. And if you're contracting the stock market, that's drawing down liquidity too. So anyway, I'm sorry for the long, convoluted answer. I just had a lot of stuff spinning around in my head.
Well, no, that's the problem, is there's so many moving parts to this.
Yeah.
And you mentioned another piece that I think is actually quite difficult to kind of balance how much of this stuff we pay attention to. Like the tariff thing has been back and forth and up and down and left and right. And it's been so confusing. I mean, I guess it serves the purpose of bringing it to light to help people that want to learn about it. But other than that, like, a lot of this stuff has just been noise, and it's very easy to get sucked down that rabbit hole. And it's hard to maintain that perspective of figuring out what's actually important and what's worth paying attention to in this time.
Yeah. And because it's such a distraction, it gets back to why I try to write that forecast, mm-hmm. so that I can keep referring back to what I think is important, and really drive. I'm like, there are days where, okay, let's see. All these tariffs are going to be coming. Okay, well, what does that do to gold and silver? Is that good to gold and silver or bad? Well, maybe it's bad, but wait a second, maybe it's good. Well, then the dollar's going up. Well, that should be bad for gold, but then all of a sudden gold and the dollar are going up at the same time. Again, it's very, it can really leave you, like I said, almost paralysis by analysis kind of thing. Mm-hmm. What I'm trying to stay focused on in the bigger picture, and whether I want to buy the dip in the metals or the miners, is as we progress economically, if we're progressing economically in a monetary policy in the way that I kind of thought this year would play out, which is not a soft landing kind of thing, a recognized recession, which again, 6 or 7 times in a row has followed the uninversion of the yield curve. Mm-hmm. And we had a record length of inversions, like 680 days or something like that. So you'd almost think for sure that there's a recession coming, and now that's kind of starting to play itself out. Fed said we get 1 or 2 rate cuts this year. Now, all of a sudden, after next week's FOMC, we get another summary of economic projections, which they do every quarter. That's going to show at least 3. I mean, we're getting the Fed funds futures start pricing in 4 or 5. Mm-hmm. So you look at this, gold goes up one day, down the next, and it's good for tariffs are good for gold one day, tariffs are bad for gold the next, and all this kind of stuff. Got to kind of stay focused on that bigger picture. Slowing global economy is impacting China. China announced $800 billion worth of economic stimulus last week. Sorry, I keep itching my nose. I get allergies today. How much of that's going to flow into commodities? Have you seen the price of copper this year? Mm-hmm. And if copper's going up, it's not going to leave silver behind. So all of the fluff, all the stuff that's just zooming at you on a daily basis, I'm trying to, and maybe I'm just a dinosaur. Maybe I'm completely dead wrong in focusing on the stuff I've always focused on. Mm-hmm. But I'm going to keep an eye on Fed policy in the economy, and then try to project forward as to how that might impact the dollar and the metals. And then from there, are we sustaining what's obviously a bull market? Because in that case, you're going to get higher lows all the time, followed by higher highs, which means you can be buying the dip and continuing to build your positions. That's kind of how I got to keep looking at it.
Yeah, it's almost as you're explaining this, I almost think that we should be, looking at the gold price almost, weekly, if not monthly kind of thing, and ignoring a lot of this short-term noise, because again, it's not necessarily useful. Like, if we understand that central bank demand is there, that confidence in many of these fiat currencies is waning, then those are very good indicators for the price of gold.
For sure. And you and I and everybody watching us, we're like maybe day traders, or we're all focused on the our own accounts and that kind of stuff. But the really big money, the stuff that really moves the market, not just central bank demand, large institutions and hedge funds and the really big family offices, they're looking for secular, big, long-term trends. So they're not looking at the hourly chart, and they're really not even looking at the daily chart or the weekly chart. It's the monthly chart. It's the quarterly chart. It's even the annual chart that lays out, how things are shifting and where they want to start moving into, one sector versus the other. Go all the way back to last year. Gold this time last year just barely begun to break out on March the 1st. It had gone up to about $2,000, a little bit above at first of December of 2023, and then was going sideways. But as it broke out in March, not only did it paint a new monthly high on the monthly chart, paint a new high on the quarterly chart as well. And then what'd you see? Then you see it begin to accelerate. And demand for gold in all its forms begin to accelerate from all of these really deep-pocketed, we're talking, like I said, institutions and really big hedge funds and the like, see that trend. And that's what they're watching. This next quarterly close for this March coming up in 3 weeks, we could very easily paint another new monthly all-time high, another new quarterly all-time high. And that's the sort of thing, again, that's like, okay, there's really something going on here. Not so much the noise of the daily chart. And just to relate this one back to the mining shares, or the stock market in general, you could say that, again, that same big money is so focused on growth, and it has been a growth-driven market now really for over a decade. The Mag 7 and all that kind of stuff, and AI or whatever is the theme of the day. That value has been, a high dividend and all that stuff has been left behind. I think at this point, you'd look at big gold mining stocks that pay a 4% dividend and trade at a 10 PE. That's a value stock, Tom. And maybe that's what we need, is that secular trend, pullback in growth and a rotation more toward value that would benefit the mining shares too. So again, you see big, large trends that if you're investing billions of dollars, not just, a couple of thousand, that's the kind of stuff you got to get right. That's the stuff you pay attention to. And that's where, again, they focus more on the bigger picture, where it's so easy for me in particular. I'm on X, I'm looking at headlines, I'm looking at the chart, look at that, look at what's happening today. When the big picture stuff is very, very positive.
Well, I think one of those things, as gold is seeming to move more into the public discussion, Besant has talked about it a couple different times, Elon and Trump as well. So let's start with talking a little bit about revaluing the gold reserves on the balance sheet. Do you think that's a reasonable course of action to be able to actually fund the government, let's say, at this point?
Well, let's start this by saying I have no idea. We're talking about things that have never happened before in our lifetime, right? The last time gold was revalued was the 1930s. So, even if, and I can make a case where they decide that gold is worth, let's say, $10,000 and put that on the asset side of the balance sheet. in market at $10,000 up from 42.22. That doesn't mean, I don't know, maybe that means gold trades at $10,000, but it doesn't guarantee it's going to trade at $10,000. Mm-hmm. I mean, if the government says we are a buyer of gold at $10,000, okay, well, maybe that would have a bigger impact. Mm-hmm. But that doesn't mean that you can go into your local coin shop with a gold eagle and they're going to give you $10,000 for it. So what we're talking about here and where all the speculation has been is this monetizing the asset side of the balance sheet. This discussion really began on February the 3rd, where Trump was in the Oval Office. I'm sure you've seen it, Tom. He signs those executive orders and then he holds it up, like this for everybody to see it. Yeah. Well, he was doing that on February the 3rd with Bessent on his right side, because he was signing an executive order creating a sovereign wealth fund. Mm-hmm. Now, who has sovereign wealth? Like Dubai or Qatar or Qatar, however you pronounce it. They have sovereign wealth funds. And that's mainly because they have one principal, export. It's controlled by the government. The government brings in all this cash and they got to, they buy treasuries with it and stuff, but they also park some in this sovereign wealth fund. Then they go buy soccer teams, whatever with it. So Trump thinks that's cool. So he wants to, okay, hey, that's great. Sovereign wealth, but you got to fund it with something, right? Now, Trump has said, well, we're going to take the tariff revenue and put it in there. That strikes me as a little bit like the Social Security Trust Fund. Remember that whole thing, Tom, where we're all paying Social Security and FICA taxes and everything, and allegedly it's going into a trust fund that's like, no, there's no trust fund, man. They take all that money and they mix it in with the general account and all those tax receipts, and it all gets spent. And it's a future liability. It's not, your money's not just sitting there somewhere growing. Mm-hmm. Okay. It's just a Ponzi scheme. So the idea that he's going to fund the sovereign wealth fund with tariff revenue, I think is, I don't know. All right. So back to February 3rd, Bessent says, Trump says, and Scott here has got some ideas on that. And he points at him and Scott talks and he says, yeah, we're looking at doing some things with the asset side of the balance sheet. Mm-hmm. Monetizing the asset side of the balance sheet. And everybody, looks at that and goes, well, let's see, what assets do the U.S. have? Office buildings, prepaid ammunition and guns and stuff like that. I mean, there's not a whole lot on the asset side besides gold. Land. And it set everybody off.
Public land.
What? Yeah, but again, all right, how are you going to monetize that? You're going to sell off sections of the Rocky Mountains at, $100 an acre and let the Chinese come in and strip mine it? I don't see where that works either. Now,
well, that's why I wanted to have this discussion with you. Is right. Like, what are these considerations? Like,
right. So what is it?
We need to think through it.
Now, they did put out a thing last week that said, hey, there's some office buildings we want to sell. Okay. What are you going to get for, a couple of 10-story office buildings? A couple $100 million? So anyway, it all comes back to gold. And Bessent, of course, then went on Bloomberg TV and said, oh, that's not what I was thinking about at the time I said that, mm-hmm. which is, of course, what he's going to say. All right, so what could you do? You carry this gold at $42.22. If you just simply decide you're going to fund, and again, this is just dot connecting. I could be, and I probably am. I'm almost assuredly dead wrong. Okay, I'm just this lunatic sitting in his office, trying to connect dots. But if you want to have a sovereign wealth fund, you got to get some cash in there to spend, to invest. Mm-hmm. With the idea that maybe we'll put $2 trillion in there and we'll invest it wisely. It'll grow to $8 trillion. And then we'll use that $8 trillion like a sinking fund to retire $8 trillion worth of debt. Okay. We got to get $2 trillion first. So if they go issuing $2 trillion worth of brand new issuance of bonds, well, now we're running a $4 trillion deficit this year instead of $2. That dog ain't going to hunt. And like I said, I don't think you could just cleave off tariff revenue and park it in there. I don't know. Maybe that, again, I don't know. Well, you know what you could do? You could prove up how much gold you actually have by auditing Fort Knox. Well, that's all of a sudden getting talked about. Or repatriating a bunch of gold under the guise of, tariffs. Okay, maybe, I don't know. Who's that? StoneX guy said that 2,000 metric tons or something had come back.
Mhm.
All right, anyway, then you say, okay, yeah, we really do have 8,000 metric tons of gold here. And we're carrying at $42 an ounce. We're going to instead market it, well, not to market, that would make that gold worth about 750 billion. Let's call it 10 grand. Now, all of a sudden, the asset side of the balance sheet has 2 trillion. That's an extra $2 trillion worth, just out of thin air, just by an accounting entry. Then why don't you take that that new 2 trillion you created and issue some, a Judy Shelton's 50-year gold indexed, whatever, new debt, totally aside from, all the existing refunding and, and new issuance at the US that the Treasury has to do. And then you take that $2.5 trillion and put it in your sovereign wealth fund. I don't know. Again, I'm just spitballing stuff. At the end of the day, it seems to be, when they're talking about monetizing the asset side of the balance sheet, that's the most obvious thing that you could do. Whether you peg the gold to $2,900 market to market, or 10,000 or 30,000 or whatever, I would think that'd have a positive impact on the actual gold price, but I don't know what it would be, because we've never seen it done before. It's fun to think about.
Exactly. And that's the thing that we need to be having these conversations about, is like, what does that actually mean? It sounds great, but what are the actual ramifications of that? And does that, does it create a new floor for gold? Does it create a new buyer for gold? Or is it just a statement?
Right.
That puts another couple zeros on the balance sheet on one side or the other.
Yeah. I mean, they carry it now at $42.22. That doesn't mean gold's trading at $42.22. It's trading at $2,900.
Yeah.
So if they carried it, at $10,000, what does that mean? I don't know. I don't know. I mean, it could be the biggest disappointment of all time. Gold goes down, gold opens up the next day down $50. Would that surprise anybody? So we'll see. It will be interesting to see how it works out. I have thought, it dawned on me in the middle of January. I was in the middle of recording a podcast for my site with Andrew McGuire, and I was asking him about all this gold that was, the spread that had opened up, spot versus futures, and why that would be, why nobody was arbitraging it, and the lack of confidence in executing that trade was why that had widened out so much. And we're starting to see these deliveries surging in New York and all this kind of stuff. And it dawned on me, I thought, they're using the tariffs as a cover for all this. I thought, what if they're just out of gold, Tom? The article came out from the Financial Times that really kind of lit a fire back in early February. That said that you got a 4 to 8 week delay to take delivery in London, not 2 to 3 days or 4 to 8 days, 4 to 8 weeks. And I've yet to see where, well, now it's back to, 4 days. Well, 4 to 8 weeks to just simply move some gold out of here, across the line or onto a truck or something, it's starting to make me think, well, maybe they're out. Maybe 31 or 3,200 metric tons of net central bank demand over the last 3 years. Maybe it cleaned them out. Well, what does that do to everything then? I mean, that's a more tangible thing than just this monetizing the asset side of the balance sheet thing. The LBMA will come out and say, the global gold market is underpinned by our, whatever it is, 8,300 metric tons of gold that we have in our vaults. Well, like 4,500 of those metric tons are the Bank of England's gold. Is that for sale? I don't think it is.
Yeah,
maybe it is.
Where's the clarification in that?
Yeah. Another big, 3,000 some odd metric tons is the gold for the big ETFs like the GLD that's custodian there. That shouldn't be for sale. Okay, so what's left over? Ronan Manley did a thing, said it's only about 700 or 800 metric tons, and that was like 5 or 6 years ago. So all of a sudden, there's 3,200 metric tons of demand for 3 years from just central banks. At the same time, all of a sudden, the LBMA says, you got to wait 4 to 8 weeks to get you. Remember Germany, when Germany tried to get their gold out 10 years ago? And they said, we'll get it to you over the next 4 or 5 years. Mm-hmm. And then when they finally started getting some gold, it was like not the gold that they deposited. It was like, some brand new bars and some coin melt bars and all this kind of stuff. Maybe a more interesting story is not so much, what's Trump going to do and what's the US going to do as a market. What happens to this whole kind of fractional reserve pricing scheme if the leverage is getting so stretched that the LBMA can't deliver gold in less than 2 months? Again, very interesting times that we live in, Tom.
And I mean, just to play devil's advocate, that could be a complete nothing burger as well. Like that, this situation could completely resolve itself and everybody's going to have to forget about it.
Yeah. And you're going to go back and going forward, be like, we saw that in 2025. Mm-hmm. And there is some precedent for this, Tom. Back as we ended 2019 and into 2020, open interest on COMEX surged to all-time highs, up around 800,000 contracts. And the amount posted every day by the CME group of exchanges for physical on COMEX was routinely 20 to 30,000 a day. I saw it as high as like 38, almost 39,000 one day it peaked at. And what was happening? There was just this game that the banks were playing with that arbitrage where, you sell here and buy there and close the spread and they're making easy money. And then COVID hits and the whole thing just blows up in their face because now all of a sudden they're not bringing metal. They can't get metal from New York to London to physically settle that arbitrage. And remember, the spread spiked to $100, and there are all these stories about, they can't fly gold, because there's no pilots because of COVID. And all of a sudden the CME has to start a whole brand new contract that's deliverable in fractional ownership of London bars. All this, the June gold deliveries in 2020 were like 60,000 contracts. It was an all-time high. Mm-hmm. Okay. Price continued higher into August of that year and then went sideways for 3 years. Mm-hmm. Okay. Well, now today, what's been going on the last couple of months? Tariff concerns and nobody's arbing that thing and the spreads have widened out and they're shipping and flying all this, 1,000 tons or whatever from New York or from London into New York. And the volume in February went to 75,000 deliveries onto COMEX, new all-time high. Sound familiar? Mm-hmm. So maybe the whole thing will just come, all this dot connecting and trying to figure all this stuff out. At the end of the day, maybe it just is what it is. And it'll all just sort itself out and go back to normal and nothing will have ever happened. But I do believe in this fractional reserve system. I do believe that's how the system operates. You determine the price through the trading of all these forward contracts and futures contracts and all these other derivatives. And then metal flows in London at that price. You got to deliver some metal at that price. Well, when all of a sudden they don't have the metal to deliver and it takes 4 to 8 weeks, that's a problem. Mm-hmm. That would seem to be a sign that maybe there's more to it than just simply, the system is fixing itself like it did in 2020. I suspect we'll know soon enough.
Yeah, that system works until it doesn't, which, we've talked about many times.
Countless times. It's the music plays and everyone's looking for and no one's looking for a chair until the music stops, right? Mm-hmm. And then everybody has to find a place to sit.
Mm-hmm. Craig, does much of this excitement extend to silver as well, or are there completely different considerations for silver due to its more industrial demand and commodity type characteristics?
That's such an interesting question, Tom. It befuddles everybody, right? Silver's kind of in between. It's a blend of gold and copper in a way, right?
And it shifts back and forth too.
Yeah, and it shifts back and forth as to which is it. As you look at the goings on, the rate to borrow gold in London spiked, and the rate to borrow silver in London has spiked. Mm-hmm. The rate to borrow GLD shares spiked.
I saw PSLV is at like a massive all-time high today.
Massive new amount of shorting. Yeah, exactly. And you're like, well, What's going on there? Well, somebody's obviously, it would seem to be borrowing shares to redeem. And you got to, I was just reading the prospectus this morning. You got to be able to redeem 10,000 ounces is the minimum size you can redeem. So you got to borrow enough shares that you can redeem that. So that would be a sign you would think that what's going on in silver is what's going on like gold. The March delivery month on COMEX, which we're now 10 days into, it was the front month, gone off the board. There were 15,800 or something contracts still open and standing for delivery at the end of February when it went off the board. Well, that's like 3 times the normal amount. I mean, so we're on track to deliver, I always say, on COMEX. I mean, maybe as many as 18,000, 19,000, that'd be like 90 million ounces. That's the entire registered category at this point. Mm-hmm. So are there signs that silver is kind of playing along the same way that gold is? Yeah. Could you also say there are signs that, if we're really just worried about tariffs, well, okay, well, that would apply to silver too, with all the silver that comes out of Canada or Mexico. Mm-hmm. So it's very difficult to sort all its way through. I just know, though, that the silver pricing scheme is just the same as gold. I could say maybe it's even worse. And that's what the gold-silver ratio is telling you at 90-1. Mm-hmm. That there's way more silver derivatives than there are gold derivatives. And maybe that's why, that ratio reflects that. Topic for another day, I suppose. But if there is stress, if indeed this is some kind of physical stress that is not yet forcing a deleverage of the system, but really stretching the leverage, then it's going to impact silver the same as it will gold. Mm-hmm. And so, again, time will just simply tell whether there's more here than meets the eye.
Mm-hmm. Well, as an extension of this stress as well, Craig, miners have seen their production costs rise along mm-hmm. with the gold price for sure, right? Do you see a time where attention comes back into the mining sector to the point that the tide ends up lifting all boats? Or do investors still have to be extremely knowledgeable about what they're buying?
I think you got to be really smart and sharp, at least still at this point. And here we go, back to the macrocast. Am I getting a little rainbows on my face when I move like this? Hey, cool. I've got a little prism sitting up here. The sunlight's coming in. Anyway, back to the macrocast. The third topic is always, okay, what do we expect out of the mining shares this year? And the easiest proxy is to use something like the GDX, right? Mm-hmm. As a, like I said, proxy for the entire industry. Well, the problem is GDX had a terrible last year relative to metals because 20% of the GDX is Newmont and Barrick. Mm-hmm. And they were all just getting crushed by their expenses going up as fast as the gold price. And so their margins weren't expanding. So this year I just said, you know what? We're not going to do it that way. I'm just going to encourage everybody. I mean, if you want to invest in this sector, don't be lazy. Even, Stanley Druckenmiller, who's, arguably one of the greatest investors of all time. What does he do when he invests in the sector? He buys GLD and he buys Newmont. And I'm like, Stan, man, that's just lazy. And too many people are like, yeah, you know what? They don't know which ones to buy. So I'll just buy the GDX.
But you could also make the argument that they're too big to be able to buy most individual miners.
I suppose that's right? True. I mean, I don't know. Could you sprinkle it around and buy AEM and Kinross and stuff like that instead? But I digress. I think the onus is upon the individual. Mm-hmm. This passive investing trend that really began about 20, 25 years ago, with the invention of index ETFs, and index funds. This passive investing, it might work fine, I guess, if you're in the stock market, because again, as long as you own this big 7 or 8, then you're going to do just fine. But for something like the mining sector, at least for now, I think you've got to be more active. People need to watch your channel. People need to find newsletter writers that really know what they're talking about. I got to buy newsletters too, because I don't need grams per ton over a certain width, and all this kind of, I think that's not my thing. Mm-hmm. So I think the onus is on the individual to do their homework. Now, eventually that rising, I mean, if we get to this point, this rising tide lifts all boats and we're really onto something, but we're not there yet. But man, it won't take much. What Monday of this week, what the market cap of the US total market cap was down like what, $1 trillion in a day?
Mm-hmm.
Was it something like that? $1 trillion. Mm-hmm. What's the market cap of the GDX is like 15 billion. So you just,
it's a rounding error almost.
I mean, you think of how much cash there is. I mean, just trillions and trillions of investable cash. You cleave off a basis point of that and apply it to the mining sector. There's just, as you said, Tom, there's just not enough things to buy. Mm-hmm. And it becomes kind of crazy. And I think this chart's in the forecast too. The thing from Bank of America that showed 71% of all financial advisors have 0% of their money in gold or the mining shares. Mm-hmm. And it's like even worse. Just to get to 1% to 2% is like another 20%. I mean, vast majority have just no exposure at all. Mm-hmm. So it gets back to that kind of growth versus value thing, whatever it takes. Remonetizing gold at 10,000 to make everybody wake up and go, wow, whoa, this gold thing, maybe there's still something to it. Whatever it takes. With all of the investable assets that are out there in the world, the amount, just the tiniest little amount could really, really move everything really quickly in our sector. But there's no signs of that happening yet. And that's why the onus, again, like I said, is on the individual to do their homework. And if you do your homework, you're going to do fine. What did Agnico Eagle and Kinross and some of those others do last year? 50, 80%? Way more than gold, the way it's supposed to work. Mm-hmm. But if you just bought the GDX, it didn't work out for you. And so I can find a different spot here. Get that coming through. So anyway.
I thought that's just the pot of gold sitting on the
yes. Right here in my office. I do hold this. I do keep this in my office. That's pretty cool. London Gold Bar? No, it's not. It's not a London Gold Bar. It's a piggy bank. Anyway.
So, Craig, for those that understand this setup that we're facing, where there's so few people invested right now, how do we apply a contrarian investing mindset to the situation that we find ourselves in today? What advice do you have for investors that are considering wanting to put more money into gold, but are hesitant at the same time because they see it, so close to these all-time highs?
That's a good question. The first thing that comes to mind, I think it's contrarian to be in our sector, to be what's the word I'm looking for? To be cautious, to be prudent, to be really, exactly. But just to be prudent, I still see people on Twitter, that show up in my comments, that make it sound like the only silver they ever bought is that, is at $48 in 2011, and that they put their entire IRA into it or something. Nobody should do that. I think you've got to have a diversified portfolio. Mm-hmm. That just has been proved. One of the modern portfolio theory or whatever that used to be called. Now, again, so as long as you're not going, okay, this is it, the world is ending, and I'm going to cash out of everything, and I'm going to move my entire IRA into physical metal or something like that, then just simply increasing your allocation from 5% to 10% or from 10% to 20%, it's not that big of a deal. Mm-hmm. In terms of waiting for the dip to buy or thinking price is too high, I would encourage anybody to look at that chart, not the daily chart, the monthly chart or the quarterly chart, and not come to the conclusion that we're in a pretty salty bull market. The average annual gain for gold in dollar terms since the beginning of the century is almost 10% a year. And depending on how you measure it, it's beating the S&P. So if we're in a bull market, then, okay, you can wait for a pullback, but you better buy the dip. You don't want to plant your flag in the ground and go, I'm not buying any gold unless it comes back down to $2,000. That may not work. So my contrarian advice would just be simple, just to be prudent. Not just think you've got it all figured out Trump's going to monetize gold. The banks are, going to be forced to let go, and and the price is going to reset at some actual new fair value by September. That sort of thing. I'd probably not a real good investment strategy.
Mm-hmm. Well, I think that's great advice to wrap up on here, Craig. Do you have anything you'd like to add to our listeners to think about before we do?
Well, I like that we've talked a lot about big picture stuff. And that's, again, there's so much speculation. And believe me, I've contributed to it in my writings and, on Twitter, because it's a fun thing to think about, these thought experiments, trying to anticipate where things are headed, are it's fun. It's engaging. It gets you thinking. And like I said, I've done my share of trying to figure out, okay, if they do this and they monetize the asset and this, and they got to fund it, like I laid out earlier. But I think what's most important for people to remember is the big picture, okay? This debt-based monetary system that we've been unanchored and untethered to anything sound since 1971. And we're in this kind of terminal phase where that debt is growing exponentially and the economic growth can't keep up. And that's just going to force some very hard choices. And eventually the system will swing back the other way like it always has. And that's where gold and silver have a purpose in your portfolio. And so, what do I sum up? Man, just keep focused on the long term. We've been doing this at my site for 15 years. I thought maybe we would make it past 2012, and here we are in 2025. Mm-hmm. So I'm not going to go putting all my eggs in one basket. That's going to happen next week. But I do feel certain that things are headed, that the math is the math, as we said. Mm-hmm. And so I want to keep preparing for that. So I'm not caught flat-footed. I want to be prepared for that to preserve my purchasing power. I want to be prepared for that by protecting the wealth I've been able to accumulate. And I can do that through owning physical gold. And it's about the only thing I know that has done that for millennia.
Mm-hmm. Well, some great words of advice there, Craig. And I appreciate your time and coming on to help us look at this big picture and keep that longer term perspective today. Tom, of course, your site, all of your writing is all available at tfmetals.report.com and of course on Twitter or X at tfmetals. Craig, thanks so much for your time today.
You bet, Tom. It's always fun to visit with you.
Likewise. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.